After an active 2 days of grain trade to start the week, price action consolidated with corn and soybean prices modestly higher, wheat prices mixed. Buyers returned to the cattle complex and live and feeder cattle futures were higher, and short covering finally rolled into futures with prices sharply higher.
Live from the turning point toward the weekend via Farm Journal broadcast, this is AgriTalk. This afternoon, it's a conversation with Craig Turner from the StoneX Group. Directly following the news, Todd Bubba Horwitz from BubbaTrading.com. Me? I'm handsome newsman Davis Michelson. Now, say hello to the host of AgriTalk, Chip Flory.
All right, Davis. Hey, thank you so much. Guess what?
Hey, buddy. What?
We're starting to get a little bit of rain here in northeast Iowa.
Is that right? Now, you weren't expecting it till later this evening, if I recall.
Right. Yep, but here it is. Very light rain, but nonetheless, I mean, it's showing us that we can get some rain here.
Yeah, and it does seem to be turning out to be a pretty good year for some early planted beans. Maybe the same will be true of some early falling rain today.
You think?
Maybe.
Yeah.
I don't know how the two come together, but it feels like there's something.
Yeah, I don't know. All I know is that we've gone about 3 weeks missing the rain chances here in my immediate area. So we'll take it. I know. I've gone from, man, oh man, it rains easy to, maybe we could have used the rain between now and 3 weeks ago, but here we are. Here we are, starting to get it. Yeah. Welcome to AgriTalk. Glad that you were here. Craig Turner is going to be with us here this afternoon. Looking forward to the conversation with Craig and, of course, Bubba coming up as soon as we get through the news. What do you got there, buddy?
Well, Chip, spring wheat trade continues to capture traders' attention as they sort the supply side of the market out. September spring wheat futures opened lower and closed above the opening range while posting an inside trading day. September spring wheat is locked in the range between $5.80 and $6. December soft red winter wheat futures opened slightly higher, dipped through support at $5.50, and then rallied to post a high range close. Wheat traders do not seem to be willing to push the downside right now, with uncertainty over supplies coming out of the Black Sea and France for the year ahead. December HRW wheat futures a penny and a quarter lower, 5.61 and 1/4. December SRW wheat up 4.5 cents to 5.56 and a quarter. September spring wheat closed at 5.92. That one's down a penny today.
Yeah, speaking of the weather and rain, it looks like Ukraine and southern Russia went through a bit of a prolonged dry spell, long enough that it's put some spring wheat yields in question, and corn yields in Ukraine as well. People are wondering exactly how that corn crop is going to handle some of the dry conditions. But, it's geopolitical issues. That's the biggest concern on the supplies out of the Black Sea.
Well, Chip, ethanol production in the week ended August 9 averaged 1.072 million barrels per day. That's up 5,000 barrels from the previous week and slightly ahead of the year-ago pace. Ethanol stocks dipped 413,000 barrels in the week, but are more than adequate at 23.354 million barrels. The lack of a threat to the U.S. corn crop is limiting buying interest, but with speculative traders loaded on the short side of the market, fresh selling was limited in today's trade. December corn traded on both sides of $4 for a third time this week. The contract opened a tick lower and near session lows and posted an inside trading day with a close near the day's high. September corn futures were 3 1/4 cents higher at 3.81. December corn up 3.5 cents, $4, 3/4 cent. March corn futures closed at 4.18 1/4, up 3.5 cents. Chip, there's a lot in that corn copy there that I want to talk about. Your thoughts?
Okay, my thoughts, number one, is that it feels like the corn market is starting to grind and grind sideways. The wheat market has been doing it for, 6 weeks? Mm-hmm. If we can get the corn market to just stop going down,
right? Yeah.
That might be all it takes to get the funds out of their short positions.
Yeah, that mention of those shorts. We'll come back to that later.
Okay.
November bean futures opened to lower and dropped to a new contract low before recovering to post a high range close. Soybean oil futures were lower with bean meal solidly higher. Spreaders were active in the product markets. The end of a strike at an Argentine soybean crusher has added a layer of pressure to oil prices, but the largest negative in the bean trade is the lack of a threat to U.S. bean yields. September beans a nickel higher, 9.52 and a quarter. Novi beans up 6, 9.68 and 1/2. Jan beans closed at 9.86 and 1/2. That's up 6 and a quarter cents, Chip.
Yeah, September soybean meal today was up $5.30 a ton. September bean oil down 28 points. Now, that was well off session lows. But when you look at the back month contracts, not only are they under the back month bean oil contracts, they're not only under 40 cents, they're well under 40 cents. January 25, 38.98 on the close today.
Yeah. Well, December cotton today was 94 points lower at 67.05. On your livestock's box beef prices were mixed this morning, with choice graded boxes down 2.30 and select boxes up 45 cents, but movement was excellent at 90 loads. October fats $1.37.5 higher today, 182.12.5. September feeder futures 217 and 1/2 higher at 244.35. And on the snout side, short covering rallied lean hog futures sharply, with October futures opening near session lows and closing near session highs. October hogs today $3, 7 1/2 cents higher, 75.92.5. December contract is up $2.50, 67.25. Chip.
All right, thank you very much, Davis. Let's bring in Todd Horwitz, BubbaTrading.com. Hey, Bubba, what's up today, buddy?
What's up? I don't know. I'm so confused. I don't know what the hell's going on.
Why? What's got you confused? Well, we've got answers.
I mean,
if I don't have an answer, Davis has got an answer.
What's up, newsman? Handsome newsman Davis Michelson. Listen, the market keeps going up. I mean, the retail prices keep going up. The wholesale prices keep going down. We're hovering around contract lows in grain and corn, beans, and wheat. Where's the sense of it? How's anybody going to make any money? How are these guys going to make a living when it comes to this year? And of course, the bank rates aren't coming down, so they're getting screwed at the bank as well. So where's the fair and equal balance here? Doesn't make sense.
I don't know.
Prices should be much higher.
What does that tell you? What does that tell you about the state of the futures markets right now in commodities?
Well, it tells me that the shorts are in full control. It tells me that somebody has got their finger on the scale and is holding them down because there's not enough volume. There's not enough market participation. We are not getting the kick because every time the equities try to sell off, in come the buyers because they're trying to rig the election and make sure that the equities are better because, of course, that's where a lot of people look at their 401ks and say, hey, I'm doing fine. No reason not to vote the same way. Listen, I think that with China bringing people in here, I think that they're trying to keep their finger on the scale of the grains, and I wouldn't be surprised if we found out that they were a big short here trying to buy farmland because some of these guys are going to be forced out of their land because they can't afford to live anymore, and they got to take the money out of the property because farm acreage is at all-time highs.
Yeah. Yeah, and they got to make money. So, you got that exactly right. It's no fun, and well, it's impossible to go year to year on the losing side of farming. No question about it. All right, buddy. Hey, we'll talk to you later.
All right, guys. Thanks. Have a great day.
You too. Todd Horwitz, BubbaTrading.com. All right, coming up next, we're going to talk grain and oilseed markets with Craig Turner from the StoneX Group here on AgriTalk.
When news breaks, the newsmakers talk about it on AgriTalk with Chip Flory.
Welcome back to AgriTalk. I'm your host, Chip. Glad that you are with us. It's Wednesday already. And here we are. Let's jump right into the conversation and bring in Craig Turner from StoneX Group. Craig, it's good to talk with you again, man. Welcome back.
Yeah, thanks for having me. I'm excited to be on.
Yeah, all right. Let's start with this. Just give me your general attitude on corn.
All right. So listen, we had that WASDE report, and it wasn't as bearish as a lot of us were fearing, right? So, okay. Even if acres come down a little bit from here, the the USDA always has a way of kind of evening it out a little bit with either the yields go up or they tweak demand. But I think having a 2 billion carryout or somewhere within there, like 100 million bushels, is fair to assume at this point, right?
Yep.
And 2 billion carryout isn't the end of the world. Now, if that means harvest lows somewhere in the high threes, low fours, we'll have some we'll have actually some selling pressure here as we come into the end of August, just with first notice day on the September futures, and a lot of DP and basis contracts probably are going to be based off of those September futures, and just the market mechanics of that usually is a drag in the end of August here. But once that comes back and we get into September here, I don't know. I mean, I've been pretty bearish for the past couple of years. I will change my tune. I mean, once we get to mid-September and we put in whatever harvest low we have, I mean, either demand has to come in, right, and start buying corn at these prices, or we're just not going to have the acres next year. And when I take a look, and we're below cost of production, and when I take a look at the balance sheets, just for what may happen next year or what needs to happen to get prices back to break even and profitable, 90 million acres and a 182 trend line yield, which 182 trend line's probably the likely yield when the ag form comes out in early 2025. We use as much as we consume, right? We're still at a 2 billion carryout. I went back, I looked at all the data from the past 20 years on planted acres for corn. Since we introduced renewable fuels and ethanol, we're rarely below 88, even like in the tariff years. So 88 million acres and a 178 yield, which would be within the norm of standard deviation or even the fear of it, gets corn over $5, right?
Yeah.
So we have this situation here where I know things look bleak right now, and they do, but we are coming into a period where I think we're going to hit multi-year lows, right, within the next, let's say, 4 to 8 weeks in corn. And when you take just a look at the balance sheets and where everything would be with acres and how it, you don't even have to have a 178 yield to get the $5 next summer. Right. You just need the fear of the 178 yield in a planting or weather to get there. And I think that's where the corn market's setting up right now.
Okay. Is demand for corn good enough right now to help you lock in that low in the next 4 to 8 weeks?
It's a great question. I think that demand is still soft, right? But, corn in U.S. is, in terms of exports, the corn is going to be favorably priced, for export here in the fourth quarter. I want to say corn is going to be about 60 to 70 cents more expensive down in South America right now than the U.S. There isn't a ton of business, coming out of the Ukraine at the moment. They still have their own issues in the Black Sea, and that hasn't been resolved. So, it'd be nice to see better demand. I unfortunately think we're really talking about supply here and the market mechanics of eventually what happens is the funds won't want to be short either past September or October. They could keep on playing that carry trade, but they look at the same tables I do. I mean, if I'm a fund, I got no problem being short for the next at least 2 weeks, maybe 4 weeks. But if I were running a fund, I would be coming out of my bearish position sometime by mid-September and either going neutral, where they would go into option writing, strategies, or just start positioning start positioning for the summer and the winter. And, just I want to remind everyone, I mean, for the past 2 years, I mean, the play, if you're just thinking of it as a fund and you're just looking at the balance sheets, the play has been to be short. And that cycle is coming to an end here.
Okay. I like that. You're not saying that this corn market is just going to turn around and go straight up. It's got to fight. It's got to fight, doesn't it? It's got to. Are you looking at the wheat market and saying, okay, well, the wheat market is at least fighting. It's at least grinding in a sideways pattern and trying to put in a low. Is that your attitude in wheat?
My attitude on winter wheat is we're past harvest. So all that selling pressure has already come and gone on the for winter wheat. We'll still have some for spring wheat, but that crop got a little bit smaller, and high protein wheat is actually still in demand. So I think I see corn acting like wheat starting next month, right? We have to get into actually the harvest period and any kind of forced selling. I mean, guys are going to have more corn they probably anticipated and didn't sell, and that's going to have to be dealt with. There's going to have to be old crop cash contracts that need to be dealt with. When you price something that's DP, the elevator may not have sold it down the road yet, so they're taking the short position in the futures market. Mechanically, it creates it's hard for corn to rally between now and the end of August. But I would say that here's the thing with wheat. While even though we're at over 40% stocks usage in wheat, and that usually means a bear market, when you take a look at major exporter stocks, we are as tight as we've been since 2007. So if I'm a fund or a trader and I'm like, okay, we've got a huge carryout for the U.S., I'm short, but I'm also looking at this major exporter market, which is really probably one of the biggest components in pricing. And I'm saying to myself, if we are getting very close to the rest of the world for running out of exportable wheat at some point in this marketing year, and if we start to see demand spill over to the United States, I can no longer be short, right? I got to be neutral or be long, because the U.S. is the world's residual supplier of wheat. So I'm not surprised we're seeing this in wheat first, and it should come first, because if you think about it, winter wheat harvest comes first. 80% of the exportable wheat in the world is in the northern hemisphere, right? And we are seeing that bottoming action in wheat, and it's the same action I think we're going to see in corn in the next 4 to 8 weeks.
All right. You said something there about corn, just kind of in a add-on comment. Makes me think you're looking for, a real harvest market when we get this thing going because of the quote-unquote extra bushels.
I do. I hate to say it, but it's hard. Like, it's one thing listen, everyone likes me a whole lot more when the markets are going up. And, not just clients, even my family, but it's just the way it is. Like, and the thing is, there's just a lot of corn out there, and there's old crop that needs to be priced, and guys are going to have more new crop than they weren't counting for. And just the market mechanics, the machine of marketing and corn and harvest, it's just, if we're playing the odds here, right, it's just that we are going to have a little bit of pressure. Now, here's the thing. The pressure in corn, because we're down so much and the funds are so short, the downside's limited. So what I would really say about the corn market is it's just very difficult to rally any kind of significant rally for the next 4 to 6 weeks.
Well, and watch basis. Basis could be pretty ugly, at least for a short period of time, even if futures are going steady.
Yeah, that's a very good point. And that's probably true, right? Unfortunately, you're going to see some places here that, that probably has some very good harvest and very big crops. And the basis for, a while there, is going to probably definitely get weaker, right?
Yeah. So. Yeah. And when the bin in town is full, the bin in town is full. That's kind of the bottom line there. We got to talk about soybeans when we come back, and we're going to talk a whole lot more about some marketing strategies, and we're even going to start to take a look at the 25 markets when we come back from the break. But first, Craig, you've got a webinar coming up. Tell me about it.
Yeah, absolutely. I got a webinar coming up in 2 weeks. It is called the Harvest and Storage Marketing Strategies for Corn and Soybeans. I basically just go into where we think the market is, a little bit more rosier picture on corn, how we're going to deal with marketing basically in this last quarter here, how we're going to start our 2025 marketing year. And you can go to grainsandoilseeds.com. That's all plural, grainsandoilseeds.com. You can register for it there.
Okay. www.grainsandoilseeds.com. All right, we're talking with Craig Turner from StoneX Group. Like I said, when we come back, we got to do it. We got to jump into this soybean market. got a feeling his outlook isn't all that cheery, but we got to get it.
Let's go to the markets page at profarmer.com and check today's closes, where December HRW wheat futures were a penny and a quarter lower at 5.61 1/4. December SRW wheat up 4.5 cents to 5.56 1/4. September corn futures 3 1/4 cents higher at 3.81. December corn up 3.5 cents to $4.75 1 cent. September beans were a nickel higher at 9.52 1/4. Novi beans up 6 cents today, 9.68 1/2. December cotton today was 94 points lower at 67.05. On your livestock's October fats, a $1.37 1/2 higher, 182.12 1/2. September feeder futures $2.17 1/2 higher at 244.35. And October lean hog futures today 307 1/2 higher at 75.92 1/2. Get more. Visit tryprofarmer.com.
Opinions expressed on AgriTalk do not necessarily reflect the views of Farm Journal Broadcasting, affiliate stations, or sponsors. I don't know what you're thinking. So call us at 855-4TALK-AG and tell us what's on your mind.
Welcome back to AgriTalk. We are in the middle of a conversation with today's guest analyst, Craig Turner from the StoneX Group. A reminder, again, he just mentioned it. I'm going to mention it again for him right now. Harvest and storage marketing strategies for corn and soybeans. It is a webinar. It's coming up in a couple of weeks. August 28th?
Yes.
From August 28th. So make sure that you check that out. Go to www.grainsandoilseeds.com to get it. Okay. Let's jump into this bean outlook. I saved it for the second segment here for a reason, Craig. It's not quite as bright.
Okay, so we have a problem in the oilseed market right now, and it's a couple things going on. We're going to have higher yields here. I mean, we had late planting, right? And we're going to have more soybeans. We saw the 87 from the USDA and that 53.2 yield. I mean, you can make an argument maybe. Worst case scenario, we were at 54. Big crops tend to get bigger, not a ton, but a little bit, right? Inch it up. So there is this worst case scenario of like a 600 million ending stock carryout. But even if it's 550, 560, 540, somewhere in the 500s, it suggests that we're going to have some kind of a harvest low, somewhere in the low nines, you would think, just based on looking at stock to usage and price analysis and the account for inflation. And this isn't an exact science, but I can see how people out there make the argument for high 8s to low 9s, just based on carry out and supply and demand. It's, in a mathematical equation that would make sense. Now, the thing is, it's kind of like, well, how do we dig out of this hole, right? Because low prices cure low prices. What's going to help us in soybeans and how long does it take? So one, Chinese demand hasn't been great, and it's not just a political issue. Like, one is China, is in their, unfortunately, it is in their best interest to not buy from the United States. It's, from a security, perspective, in China's own mind, it's probably best not to buy from the United States, unfortunately. Okay. So you got that going against us. You also have China's population starting to decrease, which is very difficult to get out of once you do that. And that means the population gets older and you may not have as much protein demand, coming out of there. So that's kind of a black cloud macro-wise looking at it. In the shorter term, the USDA is calling for a 169 coming out of Brazil next year. Now, that's, on paper, right? They haven't planted a single acre. The farmers in Brazil haven't looked at, when the USDA was estimating that, we were still 10, 11 bucks in soybeans, not 8, not 9, threatening an 8 handle at some point. You can get some kind of, spike down there before you spike back up. So you never know on that one. That might not be so bad, but let's just even say it's like 160 or 165. That's not great for exports for soybeans. So you have to take a look at, where could acres go for beans? What can we kind of, look forward to next year, right?
Right.
So what everyone needs to remember about next year is if the trend line yield is 52.5, that means planted acres has to be 85 to basically produce as much as you use, right? Now we had 83 2 years ago. We had 87 last year. Before renewable fuel, and even when China was ramping up their appetite for soybeans in the late 2000s, 2008, 2009, we were still under 80 million acres soybeans in this country. So 85 million acres and 52, we're still at, let's say, a 550 carryout. What I like to remind everyone is that, listen, if we're at 83 million acres next year, and there's even a threat of a 50 or a 51 national yield, all of a sudden we're sub 300 again on ending stocks. That doesn't necessarily mean summer rallies being to the teens, but you can get to $12 and $13, like in that kind of scenario. The problem is beans have a lot more work to do on the acres and the yield and the demand than corn does, right? So corn's kind of, it kind of seems like, the better bet. It's, and then, so what really happens here is beans kind of hangs out in this, let's say $9 to $11 range until we can either get more demand, or there's weather issues in South America. Remember this too, because South America makes up for about 6 billion, or 6.5 billion of bean production, as only opposed to like 4.5 billion here. Like, their weather rallies really matter, and they can certainly, you get some adverse weather in South America. You can really start changing balance sheets, but that's what's going to have to take. I mean, there's a reason why this is the second part of the segment here. Like, we're going to be low for probably a little while longer than wheat and corn is right now.
Okay. All right.
Yeah.
Something that you've said a couple of times talking about corn and soybeans, well, and wheat too. We're going to use as much as we grow under different scenarios. That seems to me like, if we're going to see a year in which carryover is trending down versus a year in which carryover is trending up, that's what's really setting your attitude on the extended outlook here, isn't it?
Yeah, it is. It's two things. It's one, are we trending higher or lower in ending stocks? And then, our ending stocks, where are they relative in terms of historical pricing? Like, are we burdensome? Are we adequate? Are we going to be tight? Because and it also matters a lot for the farmers out there, like for the marketing strategies that you use, because we're going to be very burdensome coming into this year, right? So like, if I need to sell soybeans, like, I have no problem then go ahead and using a collar, like, and replacing them, or using a collar, as I'm making new crop sales, using a collar to replace that, in case we get a big, market spike. Because if you're selling a put on the low end of prices, like how low, I mean, at a certain point, like, let's say we do get down to $9, just in terms of cost of production, historical pricing, stock to usage, and, using a linear regression chart, it is very difficult to argue for prices, let's say, below $9 for any length of time, right? But but it doesn't, right? But you start getting pickup in demand, and you start getting, pickup in, maybe you get lower production because, you'll grow as many corn and soybeans, let's say Iowa and Illinois, but the farther away you get from the Midwest, you'll see less soybean acres in the margins. So, that is how I look at it. That is, and the reason why I look at it that way is just like, I need to know what marketing strategies to use year over year. Like, we would never use a collar at harvest 2 years ago, right? Because you're just asking for trouble.
Well, now
you're
wait.
really looking to, right? Yeah.
So that people understand exactly what you're saying, explain a collar.
Oh, sorry. Yeah. So a collar in this case, let's say I just absolutely have to sell soybeans. Like, I got too many, I'm not going to store them, and I don't love the price. Like, we're at like $9.50 or something like that. I might go ahead and sell like the $9 put and the $11 call, and maybe they're around even money, right? And I'm willing. Let's say I sell soybeans at $9.50. Like, I'm willing to buy them back, on the board at $9 if we get down there. But what I really want is that call in case we go up. Like, for new crop 25, a $9 put costs the same as a $12 call. So if I'm willing to buy soybeans under 9 to have that call at 12, if we do rally because of lower acres, or we get a weather issue, or whether it be South America, US, I already have that call in place at $12 that I can sell into, right? And it makes it easier to make those sales if we rally into 11 or 12 bucks, during the summer. Meanwhile, if I know the cost of production is at a certain place and I can sell a put to kind of collect the money to buy the call, and I know, it's just economically, it does not work at this price for the industry for, an extended period of time, I'm just more confident in owning back or buying back any kind of grain or oil seed at those levels. So when I talk about, making sales and replacing with a collar, like I wouldn't do that when soybeans are $15, right?
Right.
But $9, like that's a different story.
Gotcha. Good stuff. Good stuff.
Yeah.
Okay. Talk to me, we're to that time of the year where the conversation about 2,025 acres is going to get started. What are your early thoughts?
Yeah, absolutely. So I think, we're still looking into it, but just based on, when you take a look at the past 15 years when corn gets this low and below cost of production, you tend to get somewhere between 88 and 89 million acres. And I always start with corn because that's the one everyone wants to plant. That's the, and honestly, that's the largest crop, not just in the United States. It's the largest crop when you add up all crops in North America. So you got to start with corn. And honestly, I think we're at 88. So if we're going to be at 88 corn, then you can kind of move over onto like where soybeans are going to be. And then when you take a look at soybeans and you see where the prices are and what the cost of production is and where we've been for the past 20 years, it does argue for low 80s, right? It could be, I'm going to start off with 83, but we're going to, we could even go lower. It's just going to depend also too on where pricing is. And listen, you never really know who can plant what. And what their financial restrictions are, kind of going to be, for the following year. But that's kind of where we are. And if that's the case, things just seem a little bit more brighter for corn. So, in terms of marketing, for 2025, we take a look at the year, and in years where you transition, let's say from burden stocks to maybe neutral, where you have a possibility of being tight, like we do with corn. That's when you would use courage calls or courage collars, because prices are going to be below $4 in the front months here, right? You can you could probably get a $5 call, out, on the cheap, right, to sell into. It's a lot. If we get lower acres, right, it's a lot easier to make that sale at $5 if you're already on the call, and that call is going to be the cheapest usually at harvest lows. And soybeans a little bit similar, but definitely a good strategy for corn.
Gotcha. Yeah. All right, Craig. Hey, man, it was good to talk with you again. Thank you so much for making time.
Absolutely. Well, I really appreciate it. I hope everyone can come to the webinar. Again, it's www.grainsandoilseeds.com.
Our name says it all. AgriTalk. What more do you need to know?
Welcome back to AgriTalk, everyone. Your pal, Davis Michelson, here, along with my pal, Chip Flory.
All right.
Huh?
Yeah, man. You got it
thanks
right.
for listening,
you got it right.
everybody. Here, it's Wednesday afternoon. Good conversation with Craig Turner. Todd Bubba Horowitz is confused. The world just doesn't seem to make sense to him anymore. Yeah. He posed the question, how is any farmer supposed to make any money? Well, you and Craig talked about a few things, and I want you to clarify something for me. When Craig uses the word collar, speaking of options strategies,
right?
Is that what you call a strangle? I've heard you talk about strangles before.
I don't want to say that for sure.
Okay.
What Craig described, okay?
Mm-hmm.
And you know what? I don't want to actually I'll say no.
Okay.
To that. And the reason that I'm saying that is because of the differing circumstances when these strategies are used.
Okay.
The collar, you want to use it when you're looking at at lows because you're going to be selling a put. Now, if that put, if the market falls below that level and you're exercised and all that kind of stuff, you're going to end up long futures if you sold a put. And don't forget, when you are selling options, you are exposed to the same margin risks that you are exposed to if you are in a futures position. When you are long options, you're not exposed to any of that margin risk. The most that you can lose is what you pay for the option. When you sell an option, your risk is unlimited, really, when you get right down to it. So you've got the same margin exposure. But if you are short a put option and the market goes down and you end up getting exercised and all of this, that's how you end up being long futures. So what he's saying is, if you do not anticipate that the corn market is, or in this case, the bean market is the example that he was using, is going to spend much time below $9, and you sell a put option that, if exercised, you end up being long futures under $9. He said, really, how scared are you of being long soybean futures under $9? That's the bottom line. See, when I was doing risk management, if I was selling a put option, it was usually for livestock producers on corn and soybean meal needs. Okay, so I'm going to be, in other words, I was always looking to shave a few pennies off of my costs by selling an out of the money put option that, hey, if I ended up being long futures at that, at the strike price minus the selling premium, if I ended up being long futures at that level, I was happy to be there. Happy to have the long coverage.
Gotcha.
So that's what that's when I would use a strategy like that. Not to say that it doesn't make sense or isn't usable in the way that Craig explained it. Okay. And hey, now that time has gone on, if I was still in that side of the market doing it aggressively every day, I might look pretty seriously at that strategy.
Okay.
Yeah.
One thing that Craig Turner from StoneX kind of kept coming back to, at least talking about the corn and the wheat. He was really talking about the sort of the harvest price cycles, the harvest lows. How is wheat acting in this harvest season? And he's expecting that there's a chance corn can act an awful lot like wheat once it reaches the same point in the harvest season.
That leaves
how would you
open the potential.
that?
That leaves open the potential for some additional downside pressure before we get into this longer sideways trading range like wheat has gotten into. The reason that I think he's saying, listen, we could be there in 4 to 8 weeks is because he anticipates that we're going to see a quote-unquote real harvest market. And a real harvest market has plenty of product moving to market leading up to harvest and in the first 35-40% of harvest, movement can be pretty heavy. Number one, you got to clean out the bins. Number two, you know how much you're going to put in the bin. Maybe that corn that's coming a little bit later is what you want to put in the bin. And so the movement gets a little heavy. In the markets that we're in right now, it could be difficult for that corn market in particular. Well, beans too, to absorb those quote-unquote extra bushels. Okay.
Yeah.
All right.
So a pretty good chance for some serious pressure on corn through that period.
Yeah.
Doesn't necessarily need to rally at the other end. Could could likely just go sideways.
Grind sideways out of it as we build that demand base back.
Which might feel like an improvement, actually.
Yeah, exactly. Just stop going down. Just stop going down. All right. National Weather Service 6 to 10 day outlook. Is that for today? Yes, that was issued today for August 20th through the 24th. Below normal temperatures expected in Minnesota, Iowa, most of Missouri, and points to the east of that. Then we are looking at near normal to above normal temperatures expected west of that line. On the precip side, near normal precipitation is expected over the western Corn Belt areas. We've got below normal precip expected from southeast Kansas, Missouri, most of Illinois, and into southern Michigan and points east and south of that. So cooling off, but a drier pattern ahead. Thanks so much for listening. We're going out on a sustainable rancher's tour tomorrow.